Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons that you need to know about building true wealth. I'm Iannuzzelli, and we're going to talk about the ATO's crackdown. The ATO are cracking down more than ever before on a list of deductions that you need to make sure that you get right come this 30 June 2024 tax year. I want to share with you a list with the 5 most important things that you need to make sure you get right in your small business and individual tax return for this financial year.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Now, I want to share with you the first thing that the ATO will be looking for in your individual income tax return this year. And property investors have always been on the ATO's radar and spotlight. But this year, they're going to place a very close emphasis on the level of deductions that you claim in relation to your repairs versus capital improvements, your interest that you're claiming, whether it's deductible or non-deductible, and are you including all the rental income and expenses from what you've paid and also from what your property manager's paid as well. So I want to start with you with the first thing, repairs versus capital improvements. Now, we've spoken about this on this channel before, but we're going to go a little bit more in depth because this is what the ATO is really targeting. They want to know that if your repairs are replacing something from old to new, well, that would be considered capital in nature, which means it needs to be depreciated. Remember, repair is just bringing something up to working order and back up to scratch without having to replace it for a brand new item. So for argument's sake, we're just replacing that doorknob on the door, or we're just giving the oven a really good clean. But if you throw out that old oven and put a brand new oven into your rental property, that will be considered a capital improvement, which means that we do need to depreciate it. One of the things that I see the most as an accountant, especially specializing in property investments, is that a lot of people say renovate their bathroom. Now, replacing some washers or maybe the shower head, that would be considered a repair in normal circumstances. But as soon as you start knocking down the whole shower and you start replacing all the tiles and the waterproofing and a brand new vanity and a new bathroom or shower hob, all of a sudden we've gone from a repair to a capital improvement. And again, that needs to be depreciated. That's number 1 on the ATO's hit list this year. Number 2 is part of all of the property managers' software now. They have not struck a deal, but they have reached a conclusion with the tax office that they'll be sending through all of the data to ensure that people are recording and disclosing all their rental income, including the water usage, together with any expenses that the property manager is paying, such as that new oven or the grass being cut. So they're getting all of the documents and software from all of the software providers in relation to the property management, and they'll be obtaining that level of data, and that's how they're going to be utilizing that to cross-check if what you've been claiming is correct. So make sure that you're getting all the claims in for any expenses that you've paid directly from yourself and getting it right from the property manager. The big one is water usage. So that's number 2 on our hit list today. Number 3 is interest. This has been in the ATO's crosshairs for a number of years. It's people claiming the right level of interest in their tax return, more commonly around the equity drawdowns that we pull out of our investment property or own home for future investments. What's happening over recent years is there's been lots of equity being gained in lots of people's investment properties or their own home. And what people are doing is they're extracting that equity out and then utilizing that for deposits plus costs to purchase an investment property. Now, in normal circumstances, when you're doing this, any interest incurred on that equity drawdown being used for investment purposes is a tax deduction and is claimed in the property that you've purchased, not the property that you've drawn the equity from. So it's very important to note the purpose of the loan dictates where we claim the expense. So if you've drawn equity from property A to purchase property B, the interest gets claimed in property B and not in property A. More importantly, what I want to advise you as part of this third point, that if you're drawing down equity from property A and utilizing that for personal purposes, such as buying a boat or buying a car for the family, you need to make sure that you pro rata and identify that that interest is not deductible. The ATO will be paying very close emphasis on this and ensuring that your interest deductions are getting claimed accordingly. Now, the fourth point I want to talk to you about today is more around small businesses, and this has been a common trap for many small businesses in the past. It's fringe benefit tax. Now, remember, if you are providing a fringe benefit to your employees, such as a car, a laptop, a phone, you're allowing them to salary sacrifice for personal items. That is a fringe benefit you're providing your employee, and therefore fringe benefit tax is applicable. Now, it's a nasty tax to pay, but nevertheless, you do need to make sure that you're keeping all your records as a small business to ensure that you are paying the fringe benefit tax on all the personal expenses that you are paying either for yourself as a director or for your employees. And a really good example of this, and mostly common in the tradie space, if you're providing a ute, let's say a 4-door passenger utility vehicle, to one of your staff members, and you allow them to use it on the weekend to take their boat or take the family away, they need to make sure they're producing a logbook. And the company will need to pay the fringe benefit tax on the private portion of the vehicle that your employee is using. If you're using your own company funds to purchase a gym membership for your staff and it is personal in nature, you need to make sure you keep a record of that. And again, fringe benefit tax is payable. For your smaller businesses, you have an opportunity where you've got an employee fringe benefit contribution. This is where you can add back certain amount of private expenses that you may have paid through the company accounts. This brings us to our last thing that the ATO is looking at, number 5. Again, for small businesses. It's the repair versus capital, very similar to the investment properties for the individual taxpayers, but now this is for companies. You need to make sure that you are depreciating what you need to depreciate. That is assets, whether you put them into the low value pool category, which means a certain rate across a number of different smaller assets, or you're depreciating the item line by line. And that could be, say, for instance, a car. And you do need to make note that the instant asset write-off rule that we had in COVID, which was very generous, has significantly reduced. So make sure that you're looking at that instant asset write-off rule and ensuring that you're not claiming above and beyond that. So very important. Number 5, they're looking at what you can claim as an upfront tax deduction versus what needs to be depreciated. More importantly, a lot of accountants are self-assessing deductions or expenses or capital items. You need to make sure that you're utilising the Commissioner's Handbook or getting a registered quantity surveyor to determine and outline what the useful life is and therefore determine what the amount of depreciation that you claim. They're the 5 things that the ATO is targeting this financial year. There's no list that you'll see, but more so murmurs that accountants get to hear from the tax office. So remember, whether you're claiming deductions for your individual tax return or you're a small business owner, make sure you don't make these mistakes or you'll be in the crosshair from the ATO in 30 June 2024. I'm Jeremy Iannuzzelli, and this is what school should have taught you.